Your bank just offered you $100,000. Should you take it? Here's what most homeowners miss. You don't need more debt. What you actually need is a smarter way to handle the pressure you're already feeling. That's why HELOCs come up in almost every conversation I have about equity. The question everyone's asking is this actually a smart move for me, or am I about to make a mistake I'll regret? Let's walk through it. Here's what I'm seeing right now. You've been paying your mortgage for years. You've built real equity. Your home might be worth $500,000 and you owe $300,000. At the same time, you're carrying credit card balances at 22% interest that won't go away. Or your kid's tuition bill is coming faster than expected. Or the house needs work and you don't want to drain your emergency fund. No one wakes up saying, I want a HELOC. What they're really saying is, I need relief, flexibility, and a plan that doesn't make things worse later. A HELOC feels like the solution because it lets you tap your equity without touching your mortgage rate. But whether it actually helps depends on what you're using it for, how disciplined you are, and whether you understand how the payment structure really works. A HELOC is not a lump sum loan, it's a revolving line of credit secured by your home. Think of it less like a refinance and more like controlled access to your equity. Here's how the structure works. There's a draw period, usually around 10 years. During that time, you can borrow as much or as little as you need, up to your limit. If you're approved for $100,000 but only use $20,000, you only pay interest on the $20,000. Payments during this phase are typically interest only, which keeps cash flow lighter. Then there's the repayment period, usually 10 to 20 years after the draw period ends. Now you're paying back both principal and interest. Your payment goes up, sometimes significantly, because you're amortizing the balance. Most HELOCs also have variable rates. They're usually tied to the prime rate. If rates go up, your payment goes up. If rates go down, your payment goes down. There's no locking it in. Most lenders will let you borrow up to about 80 to 90% of your home's value, minus what you still owe. Using our example, a $500,000 home at 80% gives you $400,000. Subtract the $300,000 mortgage, and that leaves about $100,000 available as a HELOC. So who is a HELOC actually for? A HELOC can make sense if you're consolidating high-interest debt and you're committed to not running those balances back up. It can work if you're funding a home improvement that adds value and you need flexibility in how you draw the money. It can help if you have a regular income and need a financial cushion you can tap and then pay back. And it works best if you're disciplined with credit and treat this like a tool, not free money. In those cases, a HELOC acts like a pressure release valve, not a long-term crutch. It works when you have a plan. Now, who is it not for? It may not be the right move if you're using it to fund lifestyle expenses like vacations or cars you can't otherwise afford. If your income isn't stable and you're not sure you can handle payments when rates go up, this can get risky fast. If you're already stretched thin financially, adding more debt secured by your home raises the stakes. And if you've struggled with credit card debt before and tend to run balances back up after paying them off, this is a big red flag. Because here's the reality. If you borrow $50,000 on a HELOC to pay off credit cards, then you run those cards back up to $50,000 again, you now have $100,000 in debt and your house is on the line. There are also a few blind spots lenders don't always explain clearly. Variable rates can move fast. What feels comfortable today might not feel the same if rates jump a couple of points. I've seen situations where payments increased so much that nearly the entire payment went to interest. Interest-only payments can also be misleading. Low payments don't mean the balance is shrinking. When the draw period ends, your payment can double because now you're paying principal too. This is still your home on the line. If you can't make payments, the lender can foreclose. This isn't a credit card. Equity deserves respect, not casual use. It's also tempting to overborrow. Just because you're approved for $100,000 doesn't mean you should take $100,000. Borrow what you need, not what you're approved for. And finally, fixed rate options do exist. Some lenders allow you to convert portions of your HELOC to a fixed rate. If you're borrowing a lump sum for a specific purpose, that can sometimes be the smarter move. If this is already making you rethink how you were looking at HELOCs, let me know what surprised you most. When I coach clients through this decision, we don't start with the product. We start with 3 questions. What problem are we actually solving? Is this debt consolidation, an emergency buffer, home improvement, or lifestyle spending? How long do you expect to carry the balance? If it's short-term, a HELOC might work. If it's open-ended, we need a different conversation. And what's the exit plan? How and when does this balance get paid back? If there's no clear answer, it's usually not the right time. When those answers are clear, the decision usually becomes obvious. I also compare this to a cash-out refinance. If mortgage rates have dropped since you bought your home, refinancing could give you access to equity at a better fixed rate. Sometimes that's the smarter play. Here's the reality check. A HELOC doesn't create wealth, it creates access. Used intentionally, it can provide relief and flexibility. Used casually, it delays problems instead of solving them. The difference isn't the loan, it's the plan behind it. The people who succeed with HELOCs borrow strategically and pay back intentionally. The people who struggle borrow emotionally and don't plan for what happens when rates change or the draw period ends. If you're a homeowner sitting on equity and trying to figure out whether a HELOC actually fits your situation, that's a conversation worth having calmly and without pressure. Sometimes the right move is moving forward, sometimes it's waiting, and sometimes it's realizing you already have better options. Either way, understanding the tool is the real win. Let's talk through your specific situation and make sure you're making the right call. Thanks for watching. I'll see you in the next one.